Hi, it's Josh Gardner. We put together some videos for producers and consumers of the life insurance market to further understand how products work. This is a brief description of whole life.
One of the most popular types of permanent insurance is whole life. And whole life's a little bit more complicated than some other forms of permanent insurance. So we'll take a minute and go through this. For this example, we're using $100,000 of face amount. The first thing you need to know about whole life is that it's got a guaranteed cash value. And what the guaranteed cash value is that at age 100, your face amount is going to be equal to your cash value. So if you have a $100,000 policy, when you're 100 years old, you're going to have $100,000 of cash. Now that's the guaranteed growth regardless of dividends. But this whole life contract, if you buy a whole life contract from a mutual carrier, they're going to pay you a dividend. And that's what this arrow here represents. So when the dividend is paid on a whole life contract, it's in addition to the guarantees. And when the dividend comes out, it comes out in one of four ways. The first way it could come out is just in the form of a check. The second way it could come out is it could come out and be applied to your premium and thus reducing what your out-of-pocket would be. The third one, and the third one is really what makes a whole life contract magical, is what we refer to as paid up additions. And the fourth one is the least popular dividend option, and that's accruing them with interest. Mostly because it's taxable makes it not very appealing to people. But for the case of this example, we're going to talk about paid up additions. So when the dividend comes out, it buys another piece of insurance. And that piece of insurance has its own guaranteed cash value. And that piece of insurance never requires a premium moving forward. It's completely paid up with the dividend from that 1 year. And at the end of the second year, the main policy produces a dividend and this little policy produces a dividend, and we take those two, go together, and they buy another piece of insurance. And it has its own guaranteed cash value, and at the end of the year, it kicks out its own dividend. And pretty soon those three are going together and they're buying more insurance. So when you see the whole life death benefit increasing, it's because the dividends are being used to purchase paid up insurance that doesn't require a premium. You can also do this manually. So let's just say that you had $5,000 sitting in a savings account and you rattled the crystal ball and you saw, oh, well, tomorrow I'm going to die. If you left the $5,000 in your savings account, your family would get $5,000. Now, if you rattled that same crystal ball and you took that $5,000 and you inserted it into a whole life contract, what that would do is you'd be basically manually forcing paid up additions to happen. And if on say a 40-year-old person, it would be about 1 to 4. And what that means is if 5,000 went in, that would buy a death benefit of $20,000. And the $5,000 would be sitting right there in cash value. And the following year, it would kick out a dividend. So if you knew you were going to die tomorrow and you took $5,000 and you inserted it into your whole life contract, you'd buy some more death benefit with that. Now, if you needed the $5,000 out, you take the $5,000 back out, and now instead of this being 20,000, now it's just simply 15. So that's how you can use your own money and leverage the dividends of a whole life contract to increase the death benefit.